Hey, what is going on everyone? Welcome to another video. This one is going to be a psychology video, the first one on my YouTube channel. In this one specifically, we'll talk about the shiny object syndrome or strategy hopping in trading and how it is very dangerous for the new traders. What triggers the shiny object syndrome, how to avoid it, and how it will affect your trading. So we will be briefly discussing everything regarding the shiny object syndrome or strategy hopping. Let's start with the introduction, the common experience of shiny object syndrome, constantly shifting strategy or models and mentors, and you are unsure about is this strategy or model good or should I switch to another, lack of commitment to a single model, short-term failures affecting your mindset regarding that specific model. Now let's talk about what triggers the shiny object syndrome or the strategy hopping. First one is impatience for results. Like many traders, when they come into the market, they want quicker gain, and trading is not a get quick rich scheme. You have to put the work in at least for a year and a half, and then you will expect the result from trading. The second reason is information overload. I was myself in this stage when you are like watching different mentors, different YouTube videos at the same time, and you are overloaded with the information and you are unsure which technique should I apply, or you have specific technique or tools but you can apply them. This is because you want to implement all the things you have learned at once. For example, you have to understand the higher time frame first, and then you have to understand the intermediate time frame, and then finally the lower time frame entry. So you can do it in a sequence, like identifying a swing points on the daily chart, how the daily bias works, how the daily profile forms on the intermediate time frame, how do I get on side with this move. And you can do this by applying the concept you have learned right away. Like for example, you learn about the daily profile, go to the trading view on the hindsight chart and apply those concepts at that time. Now the third reason is the social media and trading communities. This is the stage where I stuck for almost 3 months. When you are scrolling through Twitter, Instagram, or TikTok, you will see other people wins and their execution, their pipe R or 10R trades, and they will be using different strategies. Some of them are real traders and some of them are gurus, and you are affected by the real and you are feeling behind and you have that sense of being out and you are trying to trade their strategy and you are abandoning own strategy and going after that. Lack of confidence. This is the real one. Like for example, you pick up someone else's model or someone else's strategy, whether it's from a mentorship or a YouTube video, and then you jump into your charts and you are applying it right away, and this isn't working for you. That's because they have collected years of data on their specific strategy and you are trying it on your first day. You haven't figured out the high probability condition for that strategy, the low probability condition, and what is the logic behind it, and you are trading just pattern. Now the next reason is emotional trading and fear of losses. This can happen to every trader, including me. Like for example, you pick a strategy, you are trading it for a week or a month, and then you are on a losing streak. You lose 4 to 5 trades in a row due to psychological errors or the errors in that strategy itself, or you are not understanding the strategy enough. Then you are switching it due to fear of losses due to the continuous drawdown. And this also happens to traders when they are prematurely buying funded account or trading the capital when they aren't ready for it. Now the next reason is too many mentors. This is also a real thing. It happens to me too. Like for example, you have to decide which concept resonates with you. I trade order blocks, open low high close, open high low close. I learned these from the T-Traders and the MMXM trader. These are the mentors, especially the M trades and T trades, which are trading the same concept, the order block, the daily profiles, daily swings, etc. So I learned from them personally, so I don't have to switch those mentors. When you are like learning from too many mentors, like trading fair value gaps, order blocks, breaker block, etc., too many mentors at the same time can also mess with you and it will lead you to switch strategies. Now the money focus versus goal oriented. When you are driven by the immediate profit, like you want to get that money, that also triggers the shiny object syndrome, because you will see a trader pulling out 5k or 10k a day and you are feeling behind and you want that money quick, while the goal oriented traders who want to build the long-term consistency aren't chasing the new strategies. Now how the strategy hopping affects your performance. The first one is lack of consistency. You are constantly changing strategies, which is preventing you from collecting data. This is very important part and it delayed my trading by 1 year. Like for example, I would trade a fair value gap on the hourly chart, and then next day I will switch to the breaker block, or next day I will switch to a different strategy. So when you are changing strategies every week, every month, or every day, you are resetting your data. This is the important part. When you are collecting a week worth of data or a month worth of data on specific trading strategy, and next month you are abandoning it, you are also abandoning that 1 month of data with it. So it will lead to collecting new data every month, and you won't refine your model or your approach. So this is the first side effect of switching strategies. Inability to develop mastery. Mastering a specific strategy or specific trading model need a dedication and a data, which is like 6 months of data or year of data or 3 months of data. And when you are switching strategies, you are creating that surface level knowledge. Like for example, I've learned about the fair value gap. I know what fair value gap is, but I haven't tested it on back testing or trades. So I will be having that surface level of data, and deep inside I don't have that knowledge to work with. So this is also the side effect of switching strategies. Now the third one is emotional roller coaster. This is the real one. This will affect you mentally, psychologically. Frequently changing strategies will lead you to doubt and decision, burnout, fear, and frustration. Like for example, sometime you will doubt the trading and you will say, will the trading work? Is it real? And you will say that the people are lying and this isn't working. This is not because trading is fake or trading isn't working. This is because due to the shiny object syndrome, you are not stick to one strategy for months or weeks, and then you are like doubting yourself and you are afraid of taking trades, and you are like in that frustration stage. Now comes how to overcome the shiny object syndrome. So I have written a few rules which can help you overcome the shiny object syndrome. The first one is set clear goals and align with your trading style. This include writing why am I trading and what trading concept should I trade? Do the market maker model suit my style? Am I comfortable with the weekly profiles? Am I comfortable with the 1 minute charts? Am I comfortable with the fair value gap entries? So you have to ask yourself these questions and you have to select one trading style, and then you will find the mentors that are teaching that and you will align yourself with that. Now identify the execution gap. If you are struggling with a specific trading strategy or model, this could be due to the psychological reason like fear of missing out, which is leading to premature entries. Are you unsuccessfully chasing reversal? What is the issue with you? Why are you changing strategies? And you have to write those psychological errors and gaps in execution to then filter them out. Like for example, you will be trading a market maker model, but you will be taking a premature entries. You will be having that FOMO, fear of missing out. You will be catching reversals, and at the end of the day, you will say that the strategy isn't working. But in reality, this is all your fault. You are trading premature entries. You are not waiting for that reversal, chasing the market. So this isn't the fault of the strategy. It is your mental problem. Now avoid the get rich quick mentality. You have to remove the expectation of get rich quick. Like I have seen traders, they came into the market and they're saying I will be profitable in a 1 week and 1 month. In my opinion, the best time window to become a profitable trader is 1.5 years, because like you will remove all the trial and error. You will fix your psychological condition. You will find your North Star concept or strategy. It would take you around 1.5 to 2 years. You have to be patient about it. Now understand the model condition. You have to understand the condition for the specific model. Some will work in the expansion, some will work at the retracement phase, some will work in the London session, some will work in the Nibert session. Some models work on the 1 minute chart. Like you have to identify that condition for the model. You have to backtest it and remove and filter days or the session. Now backtest what you are learning. Now this is important one. When you are learning a new concept, for example, you learned about SMT divergence, go into backtesting, apply that new technique at that time, because when you are burdening it on yourself and you are learning more and more, then you will not be able to implement them all. So when you are learning a new concept, go into backtesting and verify that concept and set yourself, should I add it to my strategy or should I remove it? Is my strategy working good with this concept or without it? So you have to backtest that and learn for yourself. Now refine, don't overload. This is very, very important. Like you have to resist the urge of adding more to your trading model, because it will not help you. For myself, when I have a daily bias a daily profile, a swing point formation, and the newer session. So I'm trading the second or third candle, and this is it for me. I don't want to add more concepts to it because the nature of market is uncertain and you cannot predict it. So why adding more concept to overwhelm yourself? And it will also lead to analysis paralysis. If I tell you my story, I started ICT trading back in 2023, and at that time, like, there were tons of models. People were talking about the RSI, the moving averages, support and resistance. If we talk about retail trading, I successfully wasted 3 months trading support and resistance and finding that strategy that I was looking for. And then I discovered the ICT concept. But inside ICT concept, there were still a lot of models. Like, you will scroll through the Twitter and there were a lot of models. People were talking about the 2022 model. The silver bullet model was overhyped that time. People were talking about the market maker models, their value gaps, breakout strategies, breakup structure, and there were like millions of models on Twitter and YouTube. And especially the social media was full of those shiny object syndrome. I have strategies for about 6 months, and then I found the MMXM trader and T-Trade on their YouTube and Twitter, and I started trading their concept. I liked the idea of the daily profiles and the weekly profiles, especially the next day model, which was the breakthrough for me. I filtered everything month by month, week by week, and that was the breakthrough for me. And sticking to one strategy will also reduce the time which you require to be a profitable trader. Like, for example, if you are constantly switching strategies, it will take you 2 to 4 years to become a profitable trader, because until then you will know that this isn't working for me anymore and you will stop switching strategies. Or you can do a shortcut, stick to a one single concept, a one single model, and trade it, filter it, know the high probability and low probability conditions, and I guarantee you can be profitable within a year if you stick to a single trading strategy or a single trading model. So this is it for this video. Hope you guys have learned something from it. If you want more psychology videos like this, let me know in the comment section. Make sure to subscribe to the channel and like the video, and see you next week.